In the world of accounting, there are two major sets of standards: International Financial Reporting Standards, or IFRS, and Generally Accepted Accounting Principles, known as GAAP. Think of them as different languages for financial reporting. Understanding these standards is crucial for businesses operating internationally or seeking global investors. IFRS, developed by the International Accounting Standards Board, aims to harmonize accounting practices globally. Over 140 countries have adopted IFRS, making it the dominant standard in many parts of the world, including Europe, Asia, and South America. GAAP, on the other hand, originated in the United States and is set by the Financial Accounting Standards Board. While primarily used in the US, GAAP still holds significant influence globally. The existence of these two major standards often leads to complexities for multinational corporations, investors, and accounting professionals who need to navigate the differences. One of the fundamental differences between IFRS and GAAP lies in their underlying philosophies. IFRS follows a principles-based approach, providing broader guidelines and requiring companies to exercise judgment in applying those principles to their specific situations. GAAP, in contrast, adopts a more rules-based approach, offering detailed rules and procedures for various accounting scenarios. This distinction creates a significant difference in how companies interpret and apply the standards. Think of it this way: IFRS is like a set of building codes that outline safety standards, allowing architects flexibility in design. GAAP, however, is like a blueprint with specific instructions for every aspect of the construction. This difference in approach directly impacts how companies handle various accounting treatments, leading to variations in financial reporting. The philosophical differences between IFRS and GAAP manifest in various specific accounting treatments. Let's explore some key areas where these differences are most apparent. Revenue recognition. IFRS focuses on when control of goods or services is transferred to the customer. GAAP relies on specific criteria to determine when revenue is earned and realized. Inventory valuation. IFRS prohibits LIFO, while GAAP allows it. Intangible assets. IFRS allows revaluation to fair value if conditions are met. GAAP generally prohibits revaluation. Impairment of assets. IFRS uses a single-step approach, while GAAP uses a two-step approach. Section 4. Beyond numbers. Reporting focus and presentation. Beyond specific accounting treatments, IFRS and GAAP also differ in their reporting focus and the presentation of financial statements. IFRS emphasizes a balance sheet-centric approach, focusing on the fair presentation of a company's financial position. GAAP, on the other hand, leans towards an income statement focus, emphasizing the accurate measurement of a company's earnings over time. This difference in focus is reflected in the structure and content of financial statements prepared under each standard. IFRS requires a statement of comprehensive income, which includes all changes in equity except those resulting from owner transactions. GAAP does not have a direct equivalent to this statement. These differences in reporting focus and presentation can impact how investors and stakeholders interpret a company's financial performance and position. Section 5. Choosing the right standard, IFRS or GAAP. The choice between IFRS and GAAP depends on various factors, including a company's geographical reach, investor base, and future aspirations. Companies listed on US stock exchanges must comply with GAAP, while companies listed on many other exchanges worldwide may have the option to use IFRS. For companies operating internationally or seeking to attract global investors, adopting IFRS might be advantageous. It provides a globally recognized framework that simplifies financial reporting and enhances comparability. However, companies primarily operating within the US and with a domestic investor base might find GAAP more suitable. It aligns with the regulatory requirements and investor expectations within the US market. Ultimately, The decision to adopt IFRS or GAAP is a strategic one that requires careful consideration of a company's specific circumstances and long-term objectives. Consulting with accounting professionals and advisors is crucial in navigating this complex landscape.